Message in follow-up to the video I posted yesterday alerting the market of the upcoming liquidity crunch in the government lending space. So the message was clear. The companies that traditionally buy servicing of government loans have completely stopped bidding on servicing. They're not buyers. They have backed out of the market, and it's causing a huge impact on independent mortgage bankers. So those companies are, PennyMac's the big buyer of government loans. Freedom, Lakeview, these are companies that have traditionally always been big bulk buyers, are always in the market for government loans, and they're very consistent for a very long time. And right now they're not buying at all. And the pressure that's putting on the market is starting to show itself on the front lines to loan originators. We're starting to see lenders cancel programs, eliminate exposure to certain credit buckets. I'm sure every single loan originator saw today, whether it was lenders cutting, renovation loans, loans with credit scores below 640, loans with DTI above 45. You're going to see this continue to go on. It's not. This is going to happen just as quickly as we saw non-QM disappear. We are about to see government lending, that credit box, shrink massively. And it doesn't matter if you're in retail, it doesn't matter if you're in wholesale, it's going to impact everybody. So where's it all start and why is it happening? So the companies that buy servicing have bought servicing from all of your independent mortgage bankers, both in wholesale and retail for many years. They've stopped buying, but why are they not buying anymore? That's a really important understanding of why they're not buying. And the why is happening right here in front of us over the last couple weeks. So there's two things that drive Ginnie Mae servicing value. Now, people can make it very complicated, but at the end of the day, there's two factors that drive it. One of them is what's the likelihood that there's going to be default on these loans, okay? If there's an environment that says that it's going to be low default, well, value is going to be higher. If there's an environment that says that there could be high default, well, value is going to be lower. Other side of things, prepayment speeds. If the environment says rates are lower than when the Ginnie Mae, the FHA or the government loan was taken out, well, guess what? If rates are lower than they were when that loan was taken out, then the value of that servicing is going to be lower. Okay, the reason why is because the likelihood it's going to be refinanced and prepaid is higher. Now, if rates are higher now than they were when the person took out that loan and that servicing is tied to, well, guess what? Now you're in a situation where that servicing is going to be higher. It's going to be worth more. And the reason why it's going to be worth more is because it has a higher likelihood of not prepaying it, of actually paying their monthly payment for an extended period of time. So defaults and prepayment speeds are two of the most important factors in determining the value of servicing. It is the complete reason why we're seeing the biggest purchasers of government loans back out of buying these loans. And people can make it very complicated and talk about a lot of different reasons, but these are the two reasons why it's happening. Now, what is happening right now that is making them so concerned? Well, on the default side, tomorrow we're going to get a report on initial jobless claims for the first week since the coronavirus has impacted our economy and as a result of these shelter in place and these shutdowns of businesses. The expectation is job losses just in the first week could be anywhere from 1.5 million to 4 million in 1 week. That's more jobs lost in 1 week than in any quarter during the financial crisis. I mean, this is mass job losses. Now, what's the problem with that is a steep rise in unemployment will drive defaults, a big driver of defaults. And the problem with these jobless claims and the unemployment number is it's going to get worse each week that we see our economy shut down. So this week it might be 1 million or 2 million or potentially worst case scenario 4 million. Next week it could double, and it could double again after that. This is a limitless unemployment pit. James Bullard, the Fed chief in St. Louis, said that we could see unemployment hit 30%. 30% unemployment means that 1 out of every 3 loans we could see go into default. Huge risk. Why would somebody want to buy FHA or VA loans or any type of government loans where the borrower's risk of losing their job is highly likely over the next 3 to 6 months? Nobody wants those loans. What's the other thing that's going on right now? Factor number 2 that drives servicing values. Interest rates have plummeted They are unbelievably low right now. They're as low as they've ever been. 10-year treasuries at 0.8. Mortgage-backed securities are as sharp as they've ever been priced. Rates are as low as they can be. So what does that mean for servicing values? They're going to be worth less. These rates are better now than any loan that you've locked in the last several months. And the prediction right now is rates are going to keep getting better. They're going to keep going lower. We just saw the short-term treasury rates go into the negative. That means that there's a likelihood that the 10-year could go into negative. That means lower rates are coming. So what does that mean for somebody looking to buy servicing on these Ginnie Mae loans? They're sitting there saying, it doesn't matter if I gave the guy 3.5%. He might be able to get 2.5% in a month. That means the likelihood of prepayment is higher. These two factors have completely caused chaos in the liquidity market when it comes to the entities that normally buy government loans from a servicing perspective. Now, on the front lines, the companies that are originating these loans are now in a situation where they're going back to their loan originators and they're, again, shrinking the credit box. And it's going to continue to happen. People came to me yesterday and said, oh, they just announced this one company just announced that they're raising their minimum credit score to 640. I said, they're not done making announcements. Matter of fact, I wish these companies would just simply get it all out of the way and say, let's look further down the road. We're not set up to be a servicer. We're an independent mortgage banker. We're not a servicer. It's a whole different ball game. You can't pretend to be a servicer. These guys don't have the liquidity. They don't have the default mitigation, the loss mitigation. They don't have the default teams in place to handle default. They are not servicers. They can't do it. They can try to do it. They can pretend to do it. They're not going to be able to do it. So the reality is they're going to have to just limit their exposure to the market. They're going to have to start cutting the product, cutting the way these loans are coming into them, and at the end of the day, putting originators in a position where they're only going to be able to do conventional loans, or they're only going to be able to do non-government loans. So why is this such a big deal right now, guys? Well, on government loans, one of the things specifically on Ginnie Mae loans that's such a big deal and so different than Fannie and Freddie loans when it comes to the servicer is when a customer goes into default, the servicer has to pay the principal and interest on the mortgage payment for as long as that customer doesn't make their payments. So to give you a little perspective, when we're talking about companies like Freedom and PennyMac and Lakeview, these are companies that have 100 million plus in Ginnie Mae loans currently in their servicing portfolios. So we're talking about new loans, but this impacts everybody. This impacts all of servicing, okay? So think about this impact. They have all these loans that are going to be eligible for a refinance, which means prepayment's going to be high. They have all these loans with borrowers that have a high likelihood of being losing their job, which means there's an extremely high likelihood of defaults rising. And their exposure on a monthly basis is they actually have to make the principal and interest payment if these loans start going into default. So for every $1 billion in servicing that one of these companies has that goes into default, they have to outlay $4.9 million per month in principal and interest payments every single month. Now compound that over the year. It's a huge number. Now, what if it's $5 billion? Meaning if they have $100 billion in servicing and 5% of the loans go into default, that's $24.5 billion per month in principal and interest payments. What if it's 10%? It's $10 billion. That's $49.5 billion in principal and interest payments per month. Then it happens another month. I talked to an expert, somebody who runs loss mitigation for a lender today, and they told me, Anthony, the problem that you're going to have right now is when people go into default, the minimum amount of time that they're going to be in a forbearance agreement or in some type of modification is 3 to 6 months. But the issue is if they're out of work for 3 to 6 months and they get their job back after, let's just say they're out of work for 3 months and they get their job back in month 4, it's going to take them another 6 to 12 months to recover from being out of work, from getting behind on all their bills, from having their lifestyle completely change for those couple months. So for every 3 months they're out of work, you got to add on another 6 to 9 months of recovery time. And here we are, here's the servicer outlaying that cash monthly, paying that principal and interest payment to the bondholders. It's a big deal. It's going to have a huge impact on everybody. So people are asking, hey, is this going to be a short-term thing? Is this going to be a long-term thing? Is the government going to bail out? Guys, this is something we've never seen before, okay? This is a whole different game. The servicers that buy government loans are out of the game.